Hello everyone, welcome to our YouTube channel. Are you a budding entrepreneur? Starting your own business is thrilling, but let's be real, numbers can be scary. If financial statements make your head spin, don't worry. Today, I'm going to break down how to interpret financial statements even if you have zero financial knowledge. Watch the video till the end as I will share a simple and short video courtesy of accountingstuff.com. This video will help you in breaking down the key accounting principles in simple terms for ease of understanding. Let's dive in. First things first, what are financial statements? Think of them as the report cards of your business. There are three main ones you need to know: the balance sheet, the income statement, and the cash flow statement. These three give you the lowdown on your business's financial health. Let's break them down in plain English. The balance sheet is all about what your business owns versus what it owes. Picture it as a snapshot of your company's finances at a specific point in time. Assets are what you own: cash, equipment, inventory. Basically anything that adds value to your business. Liabilities, on the other hand, are what you owe, like loans, bills, or any outstanding payments. The difference between these two is your equity, which is what you actually own outright in the business. Simple, right?
Hey viewers, welcome to Accounting Stuff, your guide to the basics. I'm James, and in this quick video, I'll share with you what I believe is the key to understanding financial statements, specifically the balance sheet and the income statement. So let's do this. Financial statements are accounting reports that summarize a business's activities over a period of time. Essentially, they give the business's investors, lenders, and creditors an idea of its financial health. But how do they work exactly? It all boils down to one basic principle. The stuff that a business owns is equal to the stuff that a business owes. Seriously, that's all there is to it. A business owns assets and it owes liabilities to third parties, but it also owes equity to the people who own the business. For a company that's listed on a stock exchange, that would be the shareholders. So we have assets are equal to liabilities plus equity, or shareholders' equity, which is what we call the accounting equation. Now you might be thinking, how does this have anything to do with financial statements? And the answer to that is this equals sign. This equals sign tells us that a business's assets always have to balance with its liabilities and equity. In fact, when we pick a business and look at its accounting equation at a single point in time, then we're looking at a balance sheet. This balance sheet is for a business called Cash Me If You Can, which makes microchips and computer stuff. And what we're looking at is a snapshot of Cash Me If You Can's assets, liabilities, and equity at a single point in time. Essentially, it's a summary of what they own and what they owe on December 31st. Great, but at the start of this video, I said that I show you the key to understanding financial statements, and we haven't quite got there yet. Here's the balance sheet, but where's the income statement? Let's go back to the accounting equation. Assets equal liabilities plus equity, or the stuff that a business owns is equal to the stuff that it owes to third parties and its owners. But let's focus on equity. What kind of stuff does a business owe to its owners? Two things. It owes them their capital contributions and the business's retained earnings. Capital contributions is the money that the owners take out of their own pockets and invest in the business. For example, if Cash Me If You Can issues some shares and you buy one, then you've made a capital contribution. Now you're a shareholder and you're a part owner of the business. Okay, so what's the deal with retained earnings then? These are the business's accumulated profits that it's holding on to for the future. And this doesn't mean a huge pile of cash that just keeps on getting bigger and bigger. Cash and profit are two very different things. Profit is the financial benefit that a business gains when its revenues are bigger than its expenses. And a business's accumulated profits held for future use is called its retained earnings. This is what's left over after we add up all of the profits that the business has generated and take away what's been withdrawn by the owners. And that looks a little something like this. Retained earnings are made up of opening retained earnings, which is last year's retained earnings carried forward into the start of this year, plus current year profits, which is the difference between revenues and expenses, minus current year withdrawals, the profit distributions to the owners or shareholders of the business, which I'm pretty sure you've heard of. We often call them dividends. I like to think of this as the expanded accounting equation, and in my opinion, it's the key to understanding financial statements. Let me show you why. If we jump back into Cash Me If You Can's balance sheet, we can see what the business owns and what it owes on December 31st. They own $1,551,000 in assets and the same amount in liabilities and equity, because these two sides of the balance sheet are in balance. Now, if we zoom into the equity section, we can see that Cash Me If You Can owes $1,342,000 to the owners of the business, its shareholders, of which $100,000 is made up of capital contributions that the owners have put into the business, and $1,242,000 in retained earnings, or profits held for future use. Now here's where things get interesting. If we expand retained earnings, we can see what they're made of. Last year's retained earnings, which came to $1,215,500, less the current year dividends, which were $10,000. This number is negative because these profits have been withdrawn by the shareholders. And we can also see that this year, Cash Me If You Can generated $36,500 in profit. Where did they get this number from? Current year profit comes straight from the income statement, which looks like this. The income statement summarizes a business's revenues and expenses over a period of time. It's financial statement, just like the balance sheet, but this one tracks Cash Me If You Can's performance over a 1-year period and tells us how profitable they are. Pretty cool, hey? So if you go back to the accounting equation and expand it out, we can see that retained earnings is the key that links together two of the most important financial statements, the income statement and the balance sheet.
As an entrepreneur, you don't need to be a financial whiz to understand these. Just focus on the basics: assets versus liabilities, revenue versus expenses, and cash in versus cash out. With these down, you'll be able to make informed decisions and grow your business confidently. Thanks for watching. If you found this video helpful, smash that like button, share it with fellow entrepreneurs, and don't forget to subscribe to our YouTube channel for more tips on mastering your business. Got questions? Drop them in the comments below.